Hello again, Lou Brydges and Associates. I'm going to talk to you in this short segment about restructuring of mortgages, because restructuring of the mortgage is what most of you really want. Restructuring is different than modification. Restructuring is reducing the principal balance to reflect the current fair market value of the home. If the mortgage is greater than the fair market value, significantly greater than the fair market value, quite frankly, it is at best financially imprudent to pay the mortgage. $300,000 mortgage on a home that's only worth $200,000 is a bad situation to be in. And a loan modification only makes it a worse situation. It's still a $300,000 mortgage on a $200,000 house. So, restructuring. It only makes sense to stay in that house and to keep that house, and if you can get the mortgage down to something in the 190, 180 range, you've got some equity in the property, therefore it's a reason for you to pay the taxes. Until the bank agrees to restructure the mortgage, it doesn't make any sense for you to pay the mortgage and pay the taxes on the property. You have no ownership interest in it. The reason, now you may say, well, I signed an agreement that says I was going to pay this $300,000 back, and now I'm going to renege on the agreement, and when I sign a piece of paper, my word is my bond. And that's an admirable trait, and I believe that myself. Let me tell you something, though. When you signed that mortgage for $300,000, it was based on an appraisal that said the property was probably worth $350,000 or $340,000. Now it's worth $200,000. That didn't happen by accident. The reason that that something like 75% of Americans today are underwater, that is, that they owe more on the mortgage than the fair market value of the property. And I'm not talking $5,000 or $10,000 underwater. I'm talking about $100,000 underwater on average. The reason is that the Wall Street investment banks artificially inflated the value of American real estate because they were taking that additional capital, converting it into paper called collateralized debt obligations, and selling it to investors. Now, these investors aren't going to be left holding the bag either, because these investors also were sold something that is essentially an insurance policy. It's called a credit default swap or a derivative. It's very complex financial instruments, but they're essentially insurance policies that pay off when there's been a default on the mortgage. And the companies that issued those, Lehman Brothers, went bankrupt paying off on the credit default swaps. The AIG, American Insurance Group, was about to go under. But they were bailed out by you, the American taxpayer, so they could honor their obligations. So you have paid for that house, believe me. And it's not a $340,000 house. Now, that appraiser that said it was a $340,000 house was hired by the mortgage originator. The mortgage originator was getting enormous, I mean enormous, unfathomable incentives from the Wall Street investment banks that were putting these collateralized debt obligations together. That is why the appraisal came back at $340,000 for a house that is now worth $200,000. You were misled. You were unlawfully induced. I'm going to talk more in another segment about the audits, but I will assure you that like the California Recorder of Deeds assessor and like the 5 state attorney generals that have been reviewing the audits that we pioneered the use of 5 years ago, virtually every single mortgage that was originated between 1998 and 2008 that was securitized involves pervasive and multiple violations of state and federal law. In other words, you were unlawfully induced into entering into the noted mortgage. Not just by a phony appraisal hired by the originator who was getting an enormous commission for putting together the mortgage, and so that it could be sold off to investors, but violations of the Real Estate Settlement Procedures Act, the Truth in Lending Act, Regulation Z of HUD 1. Now you may say, well, but it's too late to sue for violations of those. Yes, that's true, but it's not too late for you to plead the affirmative defense of unlawful inducement. And your word is your bond, and when you sign a piece of paper that says you're going to do something, you should do it. But if you were fraudulently induced, in other words, misled, and there were violations of law in the origination of that mortgage, in other words, that led to you signing that noted mortgage, then you don't have either a moral or a legal obligation to honor that commitment. You have an obligation, a legal and moral obligation, to take care of your family. That involves giving them a home, and yourself. That involves providing a home for you and your family to live. Thus, restructuring. We will fight the case until we win, or the bank agrees to restructure, or a third-party investor comes in and buys the property and restructures the loan for you. But the key thing is stay in the home. Do not give up the land. You have rights. This is the battle over the land. It's the same battle we fought 500 years ago. It's the same battle we'll probably be fighting 500 years from now. It's always been about the land. It always will be about the land. Do not give up the land. Thank you.